Okay, today is on off record. No, on record. Today is being recorded, right? So here is how I'm gonna do it. Okay. Now, when we speak about an algorithm, okay, and now yes, I know we've spoken about this, but now we're going to talk about it properly, like in depth, right? When we talk about an algorithm, you know that an algorithm as defined on Google, on a dictionary, whatever, it's a series of step-by-step instructions, right? So step-by-step instruction to achieve your goal or objective, right? So when it comes to the markets, Forex market, any market at all, what's the goal? The goal is to grab liquidity, right? The goal is to grab liquidity. The goal is essentially to make new highs or to make new lows. And in doing that, you have what? You have range creation and you have creation. Okay. In order to achieve your goal, algorithmically speaking, you are essentially wanting to see price forming new highs or forming new lows. Now, in the process of forming a high and a low, high and a low, we have range expansion, which is what we want to get in, right? The range expansion is essentially what we want to get in order to grab that liquidity here, and potentially maybe if it goes up and down, there's liquidity here. Okay. Now to do that, we need to, we have to see price doing certain things, or the steps, one would say, right? The certain steps, right? Now, I'm not going to be reteaching any of the ICT stuff, right? I'm just going to be stating what I've seen and my understanding of it. ICT is month one. I think one of the very first slides. Okay. What it described was how the algorithm works. It works on what? The market efficiency paradigm, right? But now, what are the series of step-by-step actions or that the algorithm takes, right? We have two paths. Okay, the algo has two paths. First one is a reversal profile, and the second one is a continuation. Okay, so now the continuation one is what's going to give you your range creation. Okay, your range creation. You have your reversal and you have your continuation profile. Now, there are certain steps inside of this reversal and continuation profile. Okay, now here's how it is. We start off with a consolidation, expansion, right? And then what? Then reversal. This is your reversal profile. Now, yeah, this is overly simplified, but this is something that we need to understand. Okay, so we have the consolidation, expansion, and reversal. So what does that look like? It looks like this. For example, expansion, reversal. What does it look like? Stop hunt, break in market structure, breaker entry, and it goes and then it goes lower. Okay, then you have stop hunt, expansion, reversal, higher. These are the three components to price moves. Okay, these are three components to price moves. So there will be a point in which price comes back down, right? That is your reversal profile. Okay, this here is your continuation profile. Okay, this here is your continuation profile. Okay, but don't think about all that now. I'm just stating it, but it looks like that. Okay, now this is your first one, your reversal profile. Then secondly, you have consolidation, expansion, retracement, and then the process repeats itself, right? So what's that? That's the consolidation, expansion, retracement, and higher you go. Okay, you have all of that for this profile. So now, if you look at what's happening right now on, okay, you can see that here you have consolidation, right? Consolidation, expansion, and reversal. Take out what? Take out liquidity. See, the end goal of the algorithm is to take out liquidity. So here's that. We have consolidation, which are called it as step number 1. We have expansion, which are called step number 2. And then we have reversal, which is your step number 3. So today, that's the one I got into. Okay, I think I got into it somewhere here. Okay. Then, if you zoom in here, okay, if you zoom in over here, you can see that this is a consolidation, step number 1, expansion, step number 2, retracement, step number 3. That's your entry. Okay, that's your entry. And then same thing follows. Consolidation, expansion, retracement. How it goes. Okay. Now you cannot have this. You cannot have this happen. Okay. Go here. Let me draw it again. If you have consolidation, you have expansion, and then you have one or two paths, right? You have either retracement or your reversal. Okay. You can never have, or you can never skip an expansion back to a consolidation. Okay, after your expansion, you will either get a reversal or retracement. That is a given. You cannot expect, okay, you cannot expect this. You can't say, okay, price expands, therefore it's going to consolidate again. No. What it's going to do is it's going to expand, either reverse, or it's going to expand and retrace and go higher. Okay, now this process of going higher, as an example, let me just take it all out. The process of going higher from here is another lower time frame profile of consolidation, expansion, retracement, right? Every price leg is a product of consolidation, expansion, retracement, consolidation, expansion, reversal, right? Every price leg is like that. Now the question is, how can you determine when such and such will happen? That's when your PD arrays come into play. Okay, now that's a complete, I would say that would make up about 50 to 60% of the algo, which won't be discussed now. It will be discussed in the future, because first we want to build the foundation, right? So we'll discuss about all that later, but this is just the foundation of it. So this is how it looks like, right? We want to see price have a consolidation, expansion, reversal, giving us a what? Market maker, buy model, sell model. Okay. Otherwise, we want to have a consolidation, expansion, retracement, which is what? Something that's part of an overall market maker, buy or sell model. Okay, something that is part of the overall market maker, buy and or sell model. So is everyone with me? Can someone confirm, please? Okay, 1 second. Hold up. Okie dokie. So if everyone's okay, we can move on to the next part. All right. Next part would be low resistance, high resistance, liquidity runs. Okay. Right. Let me take it out first and move to my OneNote. What's that? Okay. Here. Is it this? Yes, it is. Okay. Right. So I'm pretty sure you guys have seen this before, obviously. Right. So just take a moment to read through it again. Let me just zoom out also. Okay. Take a moment to read through it again, and then we move to the other document also, so that we can put them together. Just send a message on the chat box once you're ready. By okay or something. Say okay or something. Okay. Oh, yeah, okay. Okay. Right. So hallmark of a low resistance liquidity run is a run above strong high, protected high, or run below strong low, protected low. Main reason that price will turn to take out low resistance liquidity is because they are not protected liquidity. They are trail stops from the previous day, week, and or retail stops from normal support resistance ideas, right? So the path of least resistance is to grab this liquidity. So when we look at bullish low resistance liquidity run, right? We obviously know that if it's the path of least resistance, it's going to be one boom, one single move up like that, or a couple of liquidity voids to the top, right? So what you want to see for a bullish low resistance liquidity run is you want to see price take out a previous day's low, or you want to see price take out another short-term low, or or a low that looks to be very, very, very protected. Okay, a low that looks to be very protected. Now, how does a low like that look like? I'm going to first show it to you conceptually. So here, okay, you have that. Now, this here is your strong low. Okay, let me draw that properly. Okay, this is here. This here is your strong low. All right. So now, when price slowly comes back down, here takes it out and then shows immediate sensitivity to the other side, right? That's your opportunity or your signal, as one would say, to buy. To do what? To take out this high. Okay, take out this high. At the same time, you need to have something below this strong low, which is what? A PDA, a discount PDA. So order block, fair value gap, all of those stuff. Okay, breakers, whatever. You want to have those below your strong low. That is why ICT also says the highest probability moves are when you have a PD array right below a low, price goes into it and then it goes higher, or you have a PD array somewhere like that and you have a high, it takes that high out and then goes lower. That is your ideal scenario for a low resistance liquidity run. All right, that's an ideal scenario for a low resistance liquidity run, either side, bullish, bearish. So apply the same thing to, this is the one you apply to a bearish low resistance liquidity run. Now for a bearish low resistance liquidity run, you have price forming a strong high, and then it fakes you out by going lower, by breaking structure also fakes you out, and then boom, it goes up one more time, and then only it goes in your real direction. Now here's the thing, when you see like, for example, let's call this your point of interest, and then you see price doing this like that, right? Now you are under the assumption that okay, you know what, it made a wick also, and so price is breaking market structure, and so yeah, I'm pretty confident with this sell, right? And then you will see that the order flow is the bearish order flow is slowly turning into bullish order flow, and then at once you get taken out, right? Now that is what that is because how I just spoke about this here. This is your jab into the PD array, right? This overall price structure here, or signature chain price over here, is equivalent to this guy. Okay, if price has not at least touched the PD array, chances are you are going to get screwed by taking a sell. Same thing on a buy. On a buy, when you lose and when price goes one more time and then goes higher, that is because you are seeing the wrong thing on the lower time frame here, and your stops are where? Here. Therefore, what happens? You become a target of a stop hunt, right? You become a target of a stop hunt, and then they go one more time into the PD array below that. Okay. When you see a reaction, right? When you see a reaction that's near your PD array, don't be fooled by the fair value gap that is reacting from. Okay, because these reactions over here tend to be from a fair value gap. You wait for the actual move near a bullish order block, breaker block, mitigation block, whatever. Okay, that's all I have to say about this. Okay, now that's the low resistance liquidity run part. So the point is, good, you want low resistance moves only. All right, if it does not provide you that sharp move up or down, then chances are you are going to get screwed, meaning you are going to be at least over here being taken out, or you're going to be over here and you get taken out, right? You wait for that move up there, then you wait for the close here, and when it closes here, it will make an attempt to go back, drop. It will make an attempt to come here, higher. Okay, that's the gist of it for a low resistance liquidity run. That's as simple as I can make it. So as the name suggests, and as I said over here, it's the path of least resistance, right? Easy money, easy profit targets. Sorry, easy take profits. Okay, so that's that. If you are behind, just let me know on the chat box. I can come back to what I was saying. Okay, then let's look at high resistance liquidity runs now, right? Now, by now you guys should be able to put together that when you have a low resistance liquidity run, right? What is this? Someone? Someone? Anyone? That is what? There's a specific word I'm looking for. Starts with L, not liquidity. I mean, liquid is there in the word, in this phrase, but it's not what I'm looking for. Yes, okay. This is low resistance liquidity. So whenever you have a low resistance move with sharp moves up or down, then what's being created? What's being created is low resistance liquidity, meaning that when price reaches another, PD array of some sort, what's the obvious target? This fellow. Okay, this guy becomes your obvious target. So when you have all of these in context, right? When you have the narrative and all like this way, you will be easily able to identify what low is sell side liquidity and what high is buy side liquidity, right? If this price leg led to a move like a sharp low resistance move, then it's creating low resistance liquidity. If this led to a sharp low resistance move down, it's creating low resistance liquidity, right? Now, like I just said at the start of this diagram, what is it doing? It has an end goal, right? So after a buy program is over, so for a buy program, we have to look at it like this. That after buy program is over, right? Obviously, price has come down, right? Price has to come down. So now when price is coming down, it doesn't just randomly come down, right? There are points in which it will reverse even higher. After going down a bit, there are points in which it will reverse even higher. That is because price is meeting with high resistance liquidity pools, right? So what if you don't have high resistance liquidity pools? You have low resistance, right? It's either high resistance or low resistance, high resistance or low resistance. You want to look for trading opportunities inside of high resistance liquidity pools to the opposite direction. But when you are faced with low resistance liquidity pools and you see a reaction from a low resistance liquidity pool, chances are that's just a rally or a decline for you to sell or buy into. So for example, see price coming down here and you see price reacting from here, right? It reacts from here and then it shows you bearishness and then it sells off. Why is that? Because there's only low resistance liquidity here, right? So in low resistance liquidity. So when you have low resistance liquidity, right? When you have low resistance liquidity, like I just said, price, I'm just showing bullish example because that's the easiest one to show. So when you have low resistance liquidity, right? What is price essentially doing to form that low resistance liquidity? Liquidity voids, right? You see very little of these dips here, but you see a lot of liquidity voids. So what does that mean? So what is price coming back down to do? Anyone? It starts with R. Yes, sir. Okay. Price is then coming back down to rebalance. Now, how is it able to rebalance? By doing what? By running low resistance liquidity. So if you have an imbalance here, fine. I'm going to run low resistance liquidity. You have an imbalance here, fine. I'm going to retrace a bit and I'm going to run low resistance liquidity. That's how it works. Okay, now granted, it's not going to be perfect like this the entire time. There will be hiccups when it goes deeper than it has to, it runs deeper than it has to, and then goes even higher than it has to. It is what it is. We can't control that and we can't anticipate that, right? We look for the confirmations only and then only we take part in it. Okay, so that is all about low resistance liquidity. High resistance. I'll give you guys 1 minute to read through this. Now it's 9:23. I'll be back at 9:25. Okay. Liquidity run. Okay. And now when we look at high resistance liquidity run, high resistance liquidity runs, we want to take part inside of price action when it shows us a sign of high resistance liquidity, meaning that when you see something like this happen, this is a high resistance liquidity pool. Okay, this is a high resistance liquidity pool, and your range of opportunities between wherever it stops from to essentially this portion here. So you can get an entry over here, or if it comes deeper, you can get an entry over here, and then price will go higher. Now, why do you trust this? Now, granted that this is a reaction from a PD array, why do you trust this? You trust this because price formed a lower low and then failed to form a higher high. Sorry, failed to form a lower high. Instead, it formed a higher high. So essentially, meaning that it's gonna the next possible scenario is, or the next highly probable scenario is for it to form a higher low, right? It's gonna form a higher low. So you want to see price then doing that and then expand. Now, this is the point in which you want to enter, or if you're aggressive, you can enter somewhere here. But this is the point in which you want to enter. All the while knowing that this is the high resistance pool of liquidity, meaning that this price action here is highly resistant to go lower. Okay, it's very highly resistant to go lower. Therefore, the path of least resistance is where? To the upside. Okay, the path of least resistance is to the upside because it's finding it very hard to go lower. And that confirmation you get when price closes above and then retraces to a PD array or rebalances to a PD array. Okay, same thing for bearish scenario. So the hallmark of a high resistance liquidity run is a failure to create a lower high or lower low after forming a lower low or lower high. Okay, that's confusing. Forget about that. The main reason that price will do this is to induce early buyers or sellers into their positions and take out their stop loss orders. Now, remember, I said earlier, if you get stopped out over here, that's essentially being induced. If you get stopped out over here, you are being induced, right? So it's very important for you to identify where the actual PD array is. Okay. So main reason that price will do this is to induce early buyers or sellers into their positions and take out their stop loss orders. So when you see something like this, when it goes to the PDRA and takes out your stops, right? You want to see almost immediate reaction, almost an immediate reaction to the downside, almost an immediate reaction to the upside. So big bodied candles, okay, large bodied candles. The continuation of price is in the direction of obvious low resistance liquidity inside of the current interbank dealing range. Okay, inside of the current interbank dealing range. So what does that mean? That means that if you let's say if you have something like this going on, so double buy side liquidity here, here, that, that. So what's the obvious low resistance liquidity? Here and here. So what does this look like? Buy model, right? Like a buy model. Now see how everything can be put together to this market maker buy model. Number one, you have low resistance liquidity. Number two, you now have your dealing range. Obviously your dealing range is going to be somewhere here, but you have your dealing range. This high, this low. Now, in order to trigger a low resistance liquidity run, what did I say? You need to take out a low, right? Short-term low or strong low. So where's the low? Here. Price goes below it into a PD array and goes up. Now, what happens then? High resistance pool, breaker entry, up we go. And this is just an example, but you can do it in any way you want. But this is just an example to show you. This is exactly how the market maker buy model works. Okay, it's algorithmic. It's algorithmic. Now, what people fail to understand, all right, people fail to understand, because I've seen so many groups on this, especially on Euro USD, right? I've seen so many groups. People are saying, okay, I think Euro USD is in a market maker buy model. I think Euro USD is in a market maker sell model, right? And then the moment they say, and mind you, a couple of them, not just one person, a couple of them are saying, okay, I think it's in a market maker buy model. And then what happens? That high resistance liquidity pool, it gets taken out and price continues to go lower. Okay, price continues to go lower. Now, what does that tell you? That tells you that when so many people, smart money traders, are thinking of the same thing, okay, when they're thinking of the same thing, chances are it's not going to work. It's going to go do the exact opposite thing. Just like how smart money concepts go against retail thinking. When a lot of smart money traders think the same thing, it's not going to go their way at all. Which is why I ask you guys, whenever you're trading, keep your bias to yourself and talk about it at the end of the day when we're done trading. Okay, so like I said, when everyone thinks of the same thing, it will not work. All right, because they think about it in such a rule-based manner, and that rule-based manner is essentially what ICT says, and it's the interpretation of what ICT says. ICT says this, therefore I should look at it like this. But ICT never gave hardline rules like that. He said you have, for market maker buy models and market maker sell models to work, you need to have what? Context. How do you arrive at this context? PD array, day of the week, time of day, all that, right? Now, not a lot of people, right, know what an order block is. I've been going through YouTube, looking at different people's YouTube channels about order blocks, right? I'll show you. Yeah, before I show you, this is it for high resistance liquidity runs. A high resistance liquidity run formed by taking a low and breaking market structure higher. So that price comes lower to an imbalance or bullish order block and goes higher. Okay. Then the other side is high resistance liquidity forms by taking a high and breaking market structure lower, goes back to imbalance or bearish order block, and reacts to go back into discount, targeting low resistance liquidity. All right. So now, before I go into this entire order block thing, is everyone cool with high resistance and low resistance liquidity? It's just a primer, right? Because now we're going to be talking about the closing price. After closing price, we're done for the day. So is everyone okay with the high resistance, low resistance? Yeah. All right. All right. All right. Okay. Now look, a lot of people, as I was saying, they call. Okay. Now look. Okay. They call every down close candle and a bullish order block. Okay, they call every down close candle a bullish order block. But the thing is, not every down close candle or up close candle is a bullish bearish order block. But now let's say that they got that context part right. Okay, let's say that they got that context part right. But even if they get the context part right, I've seen, even though they got the context part right, they look at every immediate up close or down close candle as the bearish or bullish order block. Okay. Now, if I go to euro, right? This was for tomorrow. Okay. If I go to euro, and if you look at the 15, yeah, okay, 15. If you look at this here, if now if you look at this body, right? Let me take this out. Look at this body here. This the opening, the closing is 1.16869. The closing of this is 1.16870. Okay. Now, between the two of these, this one, which let's call candle A, and candle B, which one is the bearish order block? Okay. Now, if I ask you why, what's the reasoning behind that? Why is it a bearish order block? Nice. Good. Okay. Now, if you look at, let's take a look at this entire thing here, this entire portion here, okay, is which one is the bullish order block? A, B, or C? Anyone? If you don't know, say I don't know. What about the rest? Anyone else want to say anything? Good. It's A. Okay, it's A. So you have the lowest down close candle inside of a price range, right? Now, what's the price range? From this high to this low. When did it get broken? Here. Where did it come back to? Here. A. This is your bullish order block. This one. What's the context? Context is we had a new day. Obviously, this is the Asian range. We new day. Asian range price goes up, comes down into this, and then goes higher. Now, why does this work inside Asian range? Asian range tends to be, consolidation and some form of Asian manipulation also. Well, the algorithm starts at 7 a.m. 7 p.m. US, 7 p.m. EST. Okay, the algorithm starts at 7 p.m. EST, but true day starts at 12 a.m. EST. Okay, Algo starts at 7 p.m. True day starts at 12. So if the algo starts at 7 p.m., right? Can someone tell me when do the liquidity cycles start? A or B? Okay, it's A. Remember, algo is what delivers price. So if algo starts to deliver price from 7 p.m., then what does that mean? The 90-minute cycle is every 90 minutes after 7 p.m. Okay, every 90 minutes after 7 p.m., which is why if you look at the time period I told you guys to look at 2:30 to 4, here price tends to form the high of the day. Form it here, but if you want to look at it from a London standpoint, here you go. This one or this one. Okay, and then if you want to see the low of the day formed at 8:30 to 10. So 8:30 here to 10 here. So where is that? What does that show you? Here is your 8:30 to 10. Low of the day. High of the day. Low of the day. Okay. So algo starts at 7. True day starts at 12. All right. Now moving on to the next part. Next part being the order blocks, right? Now when you further look at the order block, remember yesterday I took a sell, right? Somewhere here I took a sell. After I missed this buy, I took another sell here to go down, and then I took this buy as well, the one I recorded for you guys. And then this sell, I gotta admit, I made a mistake. This sell over here, I made a mistake because it was Friday, weekly range is capped, so it's going to return back inside the range, and took out the previous day's low also. So yeah, obviously, if it's like that, the draw on this target is going to happen next week, right? So that was my bad on this portion here, but still got something out of it. So yeah. Right, so let me talk you guys through that. Okay, here. Now, why did I enter again here? All right, the question is, okay, now, Sean, why did you enter again here? Now, see, this is your new range, meaning your high here and the low here. Okay, and then where is your bearish order block? Your bearish order block is here. Look at that. How precise is that? This is what I based my sell on. Here, down. And I also had a sell here. Remember yesterday, London, I had a sell here also until for 12 pips, I believe. Yeah, 12 pips over here or somewhere here. So where was that? That was on the bearish order block. Now, what is the bearish order block? This now, why is it this one? Because this is the highest up close candle. Here, sell number 1 here. I missed on the buy. Sell number 2 here, and I missed. I got on this buy. I got on this sell as well, but I missed this buy. I missed this buy. Now, how could you have gotten on this buy? Now, here is how, from here, I'm going to be transitioning to the closing price and the breaks instruction. Okay. If you look at this here, and I'm assuming everyone watched that video that day about the closing price. So under that assumption, I am going to be talking over here. But the break, and then we also have the grab of liquidity as well. So you have all of these lining up. So you have this, which sets the bullish order flow. Previous day's lows are what? Remember, strong lows, right? Or short-term lows. So low taken out, we have trigger a low resistance liquidity run. How will that low resistance liquidity run begin? It will first create a high resistance liquidity run. Here, this low, giving you a what? High resistance liquidity pool, right? Then price goes up, breaking structure. This is a true proper breaking structure, which is in line with your order flow. Okay, why? Because you see bullish close above, bull buy side liquidity grab, and boom we go. Now this is the point in which you see, did price attempt to even go back to this order block? No. Did price stop at this order block again? No. Why is that? Because they have been used up. They have been used up. Why? You can't expect bearish order flow to work inside of bullish order flow, right? You can't expect bearish order flow to work inside of bullish order flow. So bullish order flow set, step number one. Remember step number one. Step number two, what do you want to see? You want to see the confirmation of the bullish order flow, which is what? The true break in market structure or your shift in market structure. And price comes back lower to what? To premium discount. Premium discount comes just to discount. And now, where is your bullish order block? There you go. There's a bullish order block. Now you might say, okay, now Sean, why not the body? Why are you using the wick? Because when you have a well-bodied candle like this one here, it normally goes for the body. When you have one that's, one that has a massive wick, it goes for the wick. So that you have to understand when you can use the wick to the opening price of the body or closing price, whichever one it is. And you have to understand when you have to use the body only. Now, when you have a big wick, you are best served in a trade when you use the wick, the opening, the high or low point of the wick. When you have a nice bodied candle, you want to go for the body. Okay, that's the entry here. Up you go, lower, higher. Now, you can see that once it goes higher and comes lower and then tries to go even higher. Now this here, you see where it wicked down into, and again, this is not hindsight because I've been looking at this yesterday. Since yesterday when I hit break even over here, I had a feeling something went wrong, and that's when I realized, oh shit, order block and change of order for here. So you see this one here, right? When it goes up and comes back down, this wick and this wick over here, it's because it's using up this. Okay, using up the order block. Now what does that then make this here? Someone, what's this? Someone, anyone tell me? What is that candle? Yes, Gucci. Yes. Okay, so that's a propulsion block, meaning that when price comes back down next week, we should see price go into propulsion by showing some dollar strength, propulsion, boom, and then continuously go lower because the drawn liquidity is still at least 1.1650, and the final draw is 1.1600. Right, 1.1600. And now why am I saying that? I'm saying that because if you take a look at the weekly, what can you see? You have the break, the body closure, the break, meaning what? Chances are it's gonna cascade lower, right? It's gonna cascade lower looking for a PD array. So where's the next PD array? PD array will be this fair value gap, consequent encroachment here. Right there, over here. Right, so that's probably the next draw. So after it goes down here, the draw will be either immediately, right? It will either immediately jump down to go here, or it will take its time up and down and go back down there. But that's the story for another day. So go back to 15 minutes. Okay, so this closing price here is very important. All right, this is what determines the next move. The closure here and the return back here, because this closure and this grabbing of buy side liquidity is what it's essentially saying is, okay, we have a high resistance liquidity run, we took out a previous day's low, we want to see price retrace into a PD array and go higher. That's all it said. That's all it said. But now here's the thing. This is one of them. This is a continuation profile, right? This is a continuation profile. How so? See, consolidation, expansion, retracement. Consolidation, expansion, retracement. Now that is led from what? Look at this. You have a overall reversal profile leading to a continuation profile. Now where's the reversal profile? Here you go. Consolidation, expansion, and what? Reversal. Then you have what? Consolidation, expansion, retracement. So how that works? This up, down, up. This consolidation, expansion, reversal, consolidation, expansion, retracement. This is a what? Market maker. Someone complete it for me. It's a market maker what? Is it a market maker bar model? Yes, it is, right? It's a buy program. It's a range expansion, but since we learned all this from ICT, we have to be loyal to him. Therefore, it's a market maker buy model. Okay. So guys, give me 1 second. Just digest this and look for any other examples. Give me 1 second. I'll be back. All right, guys. So that is how you use the closing price with the buy side liquidity graph. Now let's look at sell side. Okay, sell side. From sell side, let's try to find an example. Sorry. Okay, here. Now over here, you can see that to the upside, there are a lot of wicks, right? A lot of wicks. Now, what is that? When you have a lot of wicks, okay, and you don't have a proper grab of liquidity with price closing above or below. So in this case, it's above. When you, what I'm saying is when you have a liquidity grab, but you don't have a proper closure, as you can see, there's no proper closure, then chances are, you won't see a clean move below. Okay, the proper ones are when you have a nice clean one like this, nice liquidity run. But over here, there was no nice liquidity run. You had to wait for the next day to have that nice sharp moves, right? So here, yes, we got the break above, closed, hit, closed, given, that's a given, but the liquidity grab happened over here. So although it gives you a nice sell, I'd say the sell would have been capped over here. That's where my take profit was on this particular day. I sold over here and I took profit here. That's why I didn't really want to go all the way down here because I knew it was going to take some time, and it did take some time, right? So here now, if you look at it, you have to look at what tipped you off to a break in market structure. Here, okay, here. Now, did you get a close below? No, but you did get a sell side grab. Is that enough? I would say no. And you can see why I would say no, because it came back all the way up there. Came back all the way up here to what? To what? Someone? Is it A? Is it B? Is it C? It is It is. Drum roll, drum roll, drum roll. It is C. Okay, consequent encroachment of C. Remember when the order flow is, when the order block is too big, we go for the midpoint and above, right? So this is your bearish order block, and this is your midpoint somewhere here. Might not get it perfect, but let's say somewhere here, and there you go. Okay, that's your entry. Because see, it comes better. The failure to close below, and even though it went down anyway, right, means that okay, there is a possibility for it to go back up there, because the 15-minute chart doesn't show something that what it doesn't show something that we normally would like to see, right? But if we go to the 5-minute, we can see that it did close here, it did close, and it did grab liquidity, and then it did go into this. Now see over here what happens. Where's the order block? Here. Highest up close here, and what did it use? The wick. It used the wick, right? Over here it used the wick. Because now why? Because the wick is big. Nice body, but the wick is also equally big, right? So that's the one it used. But if you are looking at it from a 15-minute point of view, then yes, consequent encroachment with the 50% mark. So price is fractal, right? Price is fractal. So anything you see, the result will still be the same. So looking at it from 5-minute perspective, since we use that for entries as well, here's your break, here's your liquidity grab, order block, down you go. This was the trade I took. Okay. Then what about this? You have your break here. You have your liquidity grab here. Then what? Then this is proper, right? It's nice and proper. So if this is nice and proper, where is your break? Your break is here. Here. Right? That's your break. Now where's your dealing range? Dealing range is from this high to this low. Where's your premium? Premium is order block. Why? Highest up close candle inside of this range. There's your order block. And there's your sell. But I did not take it over here. I took it from this one here. Stop here. Take profit where? Take profit the obvious point, which is this. So 20 pips for me is the max. So here you go. Okay, that's one way to do it. That's one way to do it. Using the idea of the close and the grab. Okay, close, body break. I call it the body break and the grab of liquidity. Then what about this portion? Now let's say you missed this portion and it wasn't that clean to you. So you waited for London close. So London close gave you the same thing. Here, nice break. Then what you're going to do, you're going to apply premium discount to high, low. Where's the bearish order block? Inside a premium here. Stop here. Take profit, same. Okay. Now, you can see that the creation of the range that you're going to be using to frame your trades inside of is what? What are we using to frame our trades inside of on the lower time frame? Bearish and bullish what? Yes. Okay. Bearish and bullish algorithmic models are used to frame the entries because why? It gives you a step-by-step thing to look out for. What's the first thing? I want to see the dealing range, interbank dealing range. After that, I want to see the price go premium. In this case, premium. Then I want to see price trade down. Simple as that. Algorithm. Here, algorithm, step-by-step instructions, right? So you have that going on for you. So that's what happened on Thursday, I believe. Yeah, Thursday. Now let's look at this. Okay. Before I move on, is everyone cool with this closing price and the break? If you are, then I have nothing more to say but to give you a small preview of tomorrow's stuff. Everyone good? I can start with tomorrow's things. No. Wait, what? No. What I need? What do I need to explain more? That continuation, reversal, the bodies and liquidity graph. Yes. So that is going to be. Let me go back. When you have something like this, right? Remember that on Thursday, I wanted to sell over here. It went my way, and then boom, hit me at break even. That's because here, you see, you have this low here, okay, low here, and then you have this close, right? You have this close. You have the close, but you don't have the break. Now you get the close, no liquidity grab, close, and then you see price changing the state of delivery, right? Now change the state of delivery. You know what that means by now, right? Change the state of delivery, and price goes higher. After which it goes into this bullish order block. And you see the sensitivity, right? You see the sensitivity inside of this bullish order block. The price then starts to go higher. So when you see this break here, body break or the body closure, and you see the failure to grab liquidity, right? Then when you see this and when you see immediate change in delivery, that means that it's not going to continue. It's going to instead continue for buy side or sell side, depending on how you see it. So buy side, so it's going to continue for buy side. So when I saw this, I was like, okay, you know what, I'm keeping it at break even, I'll let it go, because it was pointless to buy again because we are very close to the POI. And if I bought here, or if I could have got 10 pips, but got to stick to the rules and not trade inside of this guy, right? So that's the thing. If this was to go lower, right? If this was to go lower, you want to see do something like this. So you have this up, down. Right? You want to see that a nice move down, not just a move like, because then chances are it's just going to go higher. Okay, so I'd say yes, it's a new thing. I agree. I'd say just to put in some chart time with this, so that you finally get it, because the scenarios vary, right? So for example, here, yes, you had the close and the grab, right? And then you also had the close here. Let me draw it for you. You have the highest body here, and then you have the close, right? The close here. But you do have the liquidity grab? No. But even by not having the liquidity grab, you can't expect it to go boom, just go lower like that, because there's no reason, right? There's no reason. Because why? Because we are at the very end of the range, and we are just starting off London, and we want to see price, go higher and do something like that. So over here you have the body break, but nothing to do with the liquidity grab, right? And you wait for it, price goes up, you wait for the close, price takes out liquidity. So now what do you have? You have the break here, and you have the liquidity grab, and that's all good. So you have the conditions are set for a buy, and at the same time you have a interbank dealing range, right? You have your interbank dealing range, premium, discount. So what's inside discount? Bullish order block, right? So we have a bullish order block here, and then because it's a big one, we like the midpoint here. There you go. midpoint, consequent encroachment, and boom. And I took part in the buy somewhere here, and I took profits. I believe I took profits here. Should have held it, but yeah, took profits here. Okay, so all these now I wouldn't show you examples that if I hadn't taken it, right? Otherwise I wouldn't be able to explain it properly. I'm able to explain it properly because I took it. So here I did not take it here, I took it here, and that's that one. And over here I hit break even, and I was able to find out why I went wrong. So in essence, this was another buying opportunity, but one would not take it because it's not in a time zone, right? Then you move on to this. So this one, we all took the sell, I believe. We all took the sell from either here or over here. And then moving on to the next day, which was on Friday. Friday, we took part in the sell here, here. I took the small sell over here with the rested break even, and I missed out on this buy. Right now, tomorrow you guys will be looking at how to capitalize on the Asian range, the theory of Asian range, okay, and by thinking outside of the box. Not ICT says it needs to go 3 standard deviations, 3 standard deviations up, 3 standard deviations down. I'm going to buy a sell from that. No, we are going to use it in a different way. Okay, so we have that, and we are going to be looking at how to use the body break and the body break and the grab to frame a sell down, a buy up, a sell down, a buy up, a sell down. But of course, with proper context. Okay, it's easy stuff. No, not easy. It's very hard stuff. It's very hard stuff. Okay, so we gotta put some work into it. Because it was hard for me and it still is hard for me. I understand it, but it's when you fuse your psychology with the idea of knowing that I can trade up and down, I can trade up and down. You're gonna you'll either have very good results or you're gonna say, bro, I just lost my 500 account. Okay, so you gotta do it properly. So study this at the algorithmic parts properly. And see if it's for you or not in terms of what I'll talk to you guys about tomorrow. Okay, so a little sneak peek. A sneak peek would be what I had over here. So I will just show it to you guys. Just bear with me. Let me just Control Z everything. Okay, I can't go more than this. Okay, I can't go more than this. It's fine. Let me show it to you guys. Today. Copy and paste. Okay. Okay, now you can see using Friday's price action. You have this entry here, breaker, body break, blah, and all that. You have the entry, previous day's low. You have the buy that I missed to come here. You have the sell from up there, which I took again to come down here. And this is the buy. Okay, so you will be looking at stuff like this. You will be looking at here when order flow shifts, you can take a sell. Then when order flow shifts again, you can take a buy. When order flow shifts again, you can take a sell. When order flow shifts again, you can take a buy. So essentially, using Friday's data, you had 1, 2, 3, and 4. Okay, that is basically what we are going to be discussing tomorrow, completely off record, right? And of course, yes, Asian range has a part to play as well. Okay, so yes, anyone have any questions? Because I am done. Anyone? Let's look at Bitcoin, see what this. Okay, so I'm stopping the recording. Yeah, so stop.